Texas just ranked #1 in the nation for growth, and California is ranked dead last due to people leaving. I'm going to tell you why we buy in Texas, and we're going to break down the migration, and this is why we're buying $38 million piece of real estate in Texas right now. On top of that, if you live in California, you need to make 31% more just to maintain the similar lifestyle that you'd have living in Texas, purely because the cost of living is so steep. So when you look at the different tax pains in different states, if you just take that 13.3% away from your income, you have 13.3% more that you can invest into assets each year. That number may not sound like a huge number, but if you're making 200 or 300,000 a year, it's $25 to $40,000 of income that can now be allocated to investments, to cash flowing real estate, to a place where you can actually put that money to work to hedge inflation. And so those numbers are not insignificant, and you can see the data. You look at the one-way U-Haul trips, the data does not lie. People are waking up to it. They're realizing, hey, if I want to build wealth, if I want to have the opportunity to invest in this real estate, I've got to be living in a tax-free or a tax-friendly state. Yeah, we can see very clearly that there is a housing affordability gap. All that means is most people on a typical W-2 income or salary just simply are not able to afford the cost of a home. And a lot of that has to do with the incredible inflation we've seen over the last 20 years, and interest rates are high right now. So the gap between owning a home of what that costs for a mortgage versus renting an apartment, there is a large gap. And that renter's gap is what's forcing many people to be renters. And so people who move from California to Texas, they may be thinking, hey, I'm going to buy this home. And then all of a sudden interest rates moved up, and that gap got larger in Texas as well. So what ends up happening, like it or not, is most people are forced into renting an apartment or renting a home. And we're turning into a renter's nation. You look at the data of people who own single family homes just 20, 30, 40 years ago versus who are renters now, and the percentage has changed significantly, and it's going to continue to change significantly. Again, coming back to them printing currency, coming back to inflation. As they continue to inflate and print our currency, home ownership is going to become more and more expensive, and less people are going to qualify for it. Another trend we're tracking and seeing very clearly is that these high income earners, when they're younger, don't want to be locked in necessarily to a 30-year mortgage. And so many of these folks are renting apartments for the flexibility, right? They've seen their parents get locked into these mortgages. They've seen some of them not have the most profitable exit. And as soon as you own that home, whether you like it or not, there are other expenses that are going to come along with it. You got property taxes, you got insurance, you've got repairs and maintenance, you've got more you got to do. Whereas when you're a renter, you don't have those expenses. You've got one rent payment, usually, maybe some utilities, but any of that CapEx work, any of the lawn care, any of the maintenance taken care of for you. So it gives back a lot of freedom of time. So we're seeing a large percent of the younger population just stay in that renter space to give them more flexibility and less overhead. By the way, if you're an investor and you want to see exactly how we're capitalizing on this migration, scan the QR code or click the link below to schedule a call today. It's not just individuals that we're seeing leave states like California either. It's these huge corporations. Hewlett-Packard, Oracle, and even Chevron just announced that they're going to be moving to Houston. That is a huge change. And what happens is when these massive corporations relocate to different states, it brings the people, right? Because jobs create population growth. And so our job as real estate investors is to be very tuned into the data and to be tracking where these corporations, where these jobs are going, and then to be positioned to own real estate in those markets before the big changes happen. And so if you've been buying the last 3, 4, 5, 6, 10, 15 years in Dallas, and you're seeing all of this corporate migration happening, what will happen is the people will follow the jobs. And as the people come into the submarket, if there are not enough new units available, it puts pressure on rents. It puts pressure on the submarket. It puts pressure on the grocery stores, the roads, every single thing that's in that community, including the schools. There will be added pressure. And when the supply and the demand gets out of whack, rents go up. You want to be in a position to be able to enjoy that change. And that just comes down to getting ahead of the data. We're managing our portfolio of 430 million of assets. We want to be in locations where there's major diversification of large employment. We're wanting to be in places where jobs are coming, where corporations are coming. And when you can get into submarkets where there's many, many, many economic drivers, and you're not focused on just one employment or employee, the goal is to be in a place where there's many, many corporations. Tell you guys a quick story. We owned a property in a little town called Carlsbad, New Mexico. It was just a 101 unit apartment complex, and it was a very nice location. It was a B-class asset. We closed on the deal right before COVID-19 really set in. And the lesson we learned, and it was a harsh lesson learned, was we bought in a market that was 100% dependent on oil. And when that oil market went down, our occupancy went down, rents went down, and our value came down. Luckily, we had an incredible amount of reserves to help us get through the tough time, the challenging time, and that market came back, and it really had a really strong comeback. But the lesson for us is you want to be in submarkets that have many major economic drivers, as it allows you to have more, as more pain hits the market, as more variables change the market, you're in a position where you can sail through no matter what. Yeah, so as we have this massive influx of population moving into Dallas, right, zero state income tax, what we're looking for is we're looking for sellers that are under distress. That's the key word in this market right now, is you are looking for sellers that are being forced to sell. They're in a position where their lender said, hey, take it to the market. We've had your 5-year run, and it's time to liquidate and get our funds back as the lender, because they really are controlling the deal at this point. They even run the deal with a lockbox. They collect rent and give the owners their income to go and pay expenses in the order they approve. So bottom line is we're looking for A-plus locations from distressed sellers that bought about 5 or 6 years ago that are having to or being forced to liquidate, where we can now come in and offer them fair market value based off of fundamentals, because you still got great real estate, right? The real estate's still performing. You still have great occupancy. You still have great income. You still have great collections. But the problem is they overpaid and over leveraged the deal. So if you can come in and you can reposition the deal, deleverage the deal, pay off that old note, seller takes its losses, of course, you reposition the purchase price and come in with 70% fixed debt for a 7 or 10 year hold. Now, with all of the tailwinds that we have coming into Dallas, specifically in these A-plus locations where there's no new builds for the next 2 years within 2 miles of the deal, where you have an A-plus school, you've got prime premier retail right across the street. It's these types of locations where you can come in with a beautiful CapEx plan and provide the submarket, which is what that little area that we're buying in wants, to upgrade the property, and now you can move rents to be competitive with all of the other comps or our competitors in that submarket, and thereby drive net operating income. That's the goal of apartment investing, is to increase net operating income. Remember, $1 of NOI increase is $20 of value on an exit at a 5 cap. So if you can move NOI $1 million over a 5-year period, you've just created $20 million of value. That's the power of apartment investing. When you have a state with zero income tax, massive corporation relocation, the money and the people are gonna follow. If you're an accredited investor and you're tired of getting crushed by taxes and inflation, and you wanna start investing with us in deals just like this $38 million acquisition, scan the QR code or click the link in the description to schedule a call. We'll see you on the next one.